the best way to get out. I'm not an expert in it by any means, but I am familiar with it. For what you're saying is very true about the 1031, and that is a frustration about the typical 1031 exchange. And I think the other frustration also is that most people that are active owners of real estate eventually at some point want to become passive owners of real estate. But if you are 1031ing your equity every time, you are likely 1031 exchanging into an even bigger property, right?
I'm just curious, when you hear that, we call it the Netflix version of exit planning versus the Blockbuster 1031, which Blockbuster is still fine. You can still be okay with that. But what comes to mind when you hear about that new strategy, especially being that your business partner is a tax attorney?
Yeah, so I misheard you. The deferred sales trust is also definitely an interesting strategy, which has much more flexibility, and that makes a lot of sense because you're able to essentially get out. It's kind of like the last stop on your train of wealth building, or if you've got multiple 1031s and you're finally done with the 1031 train, right? That's the best way to get out. I'm not an expert in it by any means, but I am familiar with it. For what you're saying is very true about the 1031, and that is a frustration about the typical 1031 exchange. And I think the other frustration also is that most people that are active owners of real estate eventually at some point want to become passive owners of real estate. But if you are 1031ing your equity every time, you are likely 1031 exchanging into an even bigger property, right? Because if you went from $1 million to 2 million and then you exchange into a bigger property and you have to replace the debt, so you have to bring all the value, you were just exchanging into obviously what could be a lucrative investment, but also a bigger headache because you're exchanging into a bigger property, and so you're just creating more work for yourself. So I think the unique thing that we offer is the ability for someone who is an active owner of real estate to 1031 exchange into a more passive version of owning real estate through the tenancy in common, where they own a minority share of a institutional size and quality managed deal that we're running, and they're able to benefit and participate as a 1031 exchange investor through the tenancy in common.
Yeah, I couldn't agree with you more. By the way, you can learn more about Rob Beardsley by going to lscre.com, lscre.com. And if you want to learn the differences between a 1031 exchange or a deferred sales trust and a Delaware statutory trust, you can go to capitalgainstaxsolutions.com. We also recently released the best 1031 exit plan, which is not only a course on all of these, but also the service. We'll give you the 1031 service as well as the deferred sales trust as a backup plan service, because you might want to find that 1031. And by the way, if you find it, fantastic. Like you always do a 1031. It's less expensive. You maintain 100% control, maintain a stepped up basis. And like Rob said, it's one of the best ways to build wealth and continue to roll if that's what you wanted to do. However, if you want some diversification, you want some time back on your side, you can use the deferred sales trust. But oftentimes, Rob, we're actually doing a little bit of both. In fact, I just did an exit for a client out of Texas. He was selling a $6 million piece of land. He did a partial Delaware, a partial 1031 exchange, and a partial deferred sales trust. Because sometimes you have the hammer, you have the screwdriver, and maybe you have the saw, right? Each has its own utility for the tool that you're using, and it's not always a one size fits all. And sometimes people want some liquidity, some diversification, and some ability to access the capital and do their own deals and or be passive. And so that's why we like to offer all three strategies.